Hi, my name is Chris Rowe, the founder of True Market Insiders, and you're in for a real treat today. You're going to learn the 3 steps that I use to unlock massive profit potential on every single trade. I want you to be able to pick the perfect stock or ETF from a list of 27,377 possible stocks and ETFs, and then make the most profitable trade possible with it. And that's exactly what today is all about. That's my promise to you. You'll walk away with this today, and you'll be a much better trader for it. But that's not all. You're also going to learn why and how the common websites that are used for market research secretly manipulate your trading decisions without you knowing and what you can do about it. You'll also learn the real reason why I've been able to manage huge amounts of money so successfully for the last 22 consecutive years. You'll discover which big trading rule of thumb has led millions of traders and investors to do the exact wrong thing over and over again. And finally, you'll see how you can instantly boost your sector trading capabilities with one simple change to the way that you currently trade. You really don't want to miss a minute of this presentation. I'll be going pretty quickly in a few minutes or so. Please be ready for that. This is by far the most important lesson that I can give you. I know there's a lot of distractions around us nowadays, but this 3-step process that I'm about to share can change your life. So I don't want you to miss a single crucial step. So please make a commitment, stay focused. Can you do that for yourself? Close out all the browsers, close Facebook, stop checking your email, turn off your cell phone. Just give me your complete attention. All right. So many of you know me from Sector Focus, one of our products here at True Market Insiders. But some of you may be wondering who I am and why I'm qualified to teach this topic, and rightfully so. There's a lot of trading educators out there with almost no actual real-world experience at managing money. So essentially, some of these guys just got lucky once or twice or for a few years or a couple years, and they can't consistently replicate their initial performance. And from there on, they're basically just teaching you how they got their fluke returns from years past. So with me, my 22-year financial services background as an institutional money manager, as a hedge fund manager, as a market analyst, I'm quite literally the opposite, the polar opposite to those trading educators. So here's a very condensed version of my story. So back in 1995, age 17, took my first step into my career on Wall Street. It was an investment bank and broker-dealer. Eager? Yes, very. Hungry for big money? Yes. Was it like what you see in that movie Wolf of Wall Street? No, not exactly. But I did experience an inside view to the markets that most traders simply never get a chance to see. And I soaked up everything that I could learn from some of the smartest investors out there. Throughout the roaring 90s, for those who don't know, the 1990s were a big bull market, one of the biggest ones in history. Throughout the roaring 90s, the majority of investment capital that I was managing at that point was invested in equities, which is stocks. I was invested in index funds, again, stocks, and sophisticated equity option strategies. I quickly became the head options trader at my firm. I worked my way up really quickly, so pretty soon I was managing and I was hedging many of the firm's largest accounts, and I was assisting on the trading desk too right away, helping the traders with the firm's capital. From 99 through the second quarter of 2000, I worked for a New York Stock Exchange member firm. H.D. Browse specialized in short sale bearish trading ideas, so profiting from prices declining. I participated in underwriting lots and lots of IPOs, initial public offerings, secondary follow-on offerings, private placements, things like that. Later in 2000, a lot of people don't know this, but even though the general stock market was headed south through the year 2000, IPOs were still hot. So I went and became the third employee at a pretty early stage company, IPOsyndicate.com, owned by Mercer Partners, and I helped pioneer individual investors' access to IPOs. They were typically restricted to institutional investors at the time or the ultra wealthy individuals. If you're a regular investor, you could not get your hand on any IPOs. But we basically changed the industry in that regard. In 2004, I started an investment research firm and education firm called Tycoon Research. And we sold investment research, we sold guidance to hundreds of thousands of investors, and my team and I launched an online classroom platform called Socrates, and we launched it with about 20 online video courses that were taught by professional money managers only. So we only hired people that had real world money management experience, just like here at True Market Insiders. And we thought that was a really big deal back then because across most of the industry, you had these people teaching subscribers how to invest, but these folks teaching them had zero real-world money management experience. So you did a little bit of digging, a little bit of research on who my future competitors were going to be, and you found out there were people that started out in customer service. They're just personable, they got along well with people, or good writers, but not actual money managers. I also created and launched an algorithmic automated trading system and created technical indicators and investment tools just from raw market data. Then I went on to join the Oxford Club in January of 2014. At the Oxford Club, I was director of investing education. I was the chief technical strategist there. And we had over 70,000 members worldwide, paying members spread throughout some of over 100 countries, and combined wealth estimated over 13 billion. A variety of other things, but I don't want to make your eyes glaze over at the screen. I just really want you to know that what I'm teaching you here is founded in real world experience. Nowadays, I spend my time focusing on educating investors through True Market Insiders, like I'm doing today with this presentation with you guys. Today, I'm passing the best parts of my knowledge on to you. And what this all comes down to is you making more money. It's more money to do the things that you want to. For me, at the end of the day, I trade and I invest for my family. There's nothing that makes me happier than being in a profession that lets me spend as much time as I like with my kids while still making money that I want and then some. So let me ask you a question. If you guys can, you can type in the comments box, why do you trade and invest? Like, what's your why? I want you to think about this because mastering what you learn here today could really open up big doors for you. This could be the key to affording whatever it is, the upgrades on your home, the key to paying off your mortgage or any loans. This could be your way to fund a new annual vacation tradition to Hawaii. It could help you better prepare for your retirement years. That's how important this is. It's all up to you. Power is right inside this 3-step process. So buckle up, here we go. So here's why we're here today, to learn my 3-step process that's going to unlock massive profit potential on every trade. First and foremost, always focus on sectors like industry groups. Admittedly, you probably recognize this step as a fundamental principle from my teachings in sector focus, but it can't be stated enough. I've talked with lots and lots of my members. Many of them get this point, but they don't live and breathe it the same way that I do, and I need you to live and breathe it. It's the most important foundation for all of your trades. It's the most important thing you can think about in the stock market or even the bond market or commodities market and so on is sectors. So breaking the market down into sectors and thinking of the market in terms of sectors. What I'm going to do here today is show you the difference between sector performance on a few different years. And what you're going to notice is that even if you made a great set of trades in a year, if it was in the wrong sector, you're probably going to lose anyway or make a lot less than you should have been making. Alternatively, if you were in the right sector, even if you did the bare bones minimum, you might possibly have been making a steady profit all year around. So let's look at 2017 here on our screen. The S&P 500 index, which is what most people call the stock market, gained 21.83%. It was a great year. But here, if you look at it in terms of sectors, you can see the energy sector was down 1%, even though the stock market was up 21.83%. So what does that tell us? Well, first of all, one thing to consider is 90% of professional stock market fund managers underperformed the stock market average. So 90% returned their investors less than that 21.83% that the stock market returned. You could have beaten the stock market's return and beaten 90% of those fund managers who make millions of dollars, professional fund managers. You could have beaten them if you simply did not own energy stocks in 2017. So this chart shows the stock market divided into the major sectors. If you just eliminated energy stocks, members of the energy, stocks that are members of the energy sectors, from the S&P index, you would have beat the market. Again, something that less than 10% of professional fund managers are able to do. Now, look at the technology sector, on the other hand, up 34%. In the same year, the stock market returned 21.83. So the tech sector profited over 50% more than the stock market average did. The dispersion between the best performing sector and the worst performing sector was 35%. So if you look between technology being up 34%, and energy being down 1%, the sector dispersion is 35%. Take a look at another year, just a few more. 2016, it was a very different story. In fact, energy stocks weren't the worst performer. This time they were the best performer, up over 28% when the stock market average returned less than 12. The energy sector returned more than double the stock market's return. So with the energy sector up 28% and the healthcare sector being the worst performing sector down 2%, so that's a sector dispersion totaling 30%. All right, let's look at 2015. You can see more than half the sectors were down and the stock market only gained 1.4%. If you owned energy stocks, you were hit with a decline of 22%, while financial stocks gained 10%. So the sector dispersion here was 32%, with energy down 22 and financials up 10. So it's a 32% spread. In 2007, that was the year that the stock market made a major top before crashing in 2008. There was a huge dispersion. Energy sector was up over 36%. Consumer cyclicals and financials were down 14 and 22% respectively. That's a 57% difference in returns in between the sectors in just 1 year. Energy was up 37%, financials were down 20%. So that's a 57% dispersion. We're going to look at just one more here. Finally, 1999. A lot of people remember this year. Technology was up over 65% for the year. Some of the more narrowly focused sectors, called subsectors, within the technology sector were up several hundred percentage points that year. But when you're looking at these major sectors, the dispersion was 80%. Since the tech sector was up 65%, consumer staples was down 15%. So it's a spread. It's a dispersion of 80 percentage points. So the key is to be in the right sectors. Whether the stock market is in a bull market or a bear market doesn't matter as much if you can just focus on sectors. Shouldn't matter to you what the general stock market does unless your stock portfolio is constructed exactly the same way as the S&P 500 or the Dow 30 or the Nasdaq Composite, whichever one you follow most. Let's take a look at the black bars on this chart because that's what we just covered. All right. So in other words, the stock market was divided into 10 major sectors. The black bars on this chart represent the dispersion between the performance of those major sectors that we were talking about. We just looked at 1999. We said the dispersion between the tech sector and the consumer staple sector was 80 percentage points, right? So if you look on the left side of this chart, you'll see the same year, 1999, and the black bar goes up to 80% because that was the dispersion that year. The average dispersion of those 10 major sectors between, the best and the worst over this 16-year study, 38.46%. So on average, on your average year, there's a 38.46% difference between the best performing major sector and the worst performing major sector. So think about the impact that has on your portfolio. If you invest in the stock market and in general market averages over the long term, like 20 or 30 year timeframes, you're gaining an average of something between 6% and maybe 9% if you're reinvesting your dividends. But we just said that the average dispersion over these 10 major sectors over this 16-year study, 38.46%. So think about the impact that can have. What happens when we divide the market even further into more narrow groups is you see a much larger dispersion. Like instead of just the tech sector, within that you've got the software sector, computers sector, semiconductor sector, internet. They're all tech stocks, but they're subsectors. So you look at 1999, as I said earlier, remember I told you the dispersion was over 200%. The average dispersion for the 10 major sectors was 38.46%, but the average dispersion is 98% for the subsectors, much bigger. So imagine the power of tracking the 41 subsectors' strength. You want to focus on the narrow sectors. If you have an appetite for more volatility in exchange for higher potential returns, you definitely want to focus on the more narrow sectors. If you want a little bit less volatility in exchange, you get a little bit of a lower return, but still beating markets, focus on those bigger major sectors. So step one of the 3-step approach is obviously to focus on sectors. Now, you probably heard the old adage, a rising tide lifts all boats, but that's probably the most dangerous adage floating around the financial media and even investing educators out there. It's so dangerous because it's just not true. So don't think that just because the stock market's going higher, that the stock that you own is more likely to go up. That's a flat out lie. People don't understand how the stock market works or how these averages are weighted, and they believe that, but it's not true. I've just proven by showing you sector charts that it's not true. However, a rising tide lifts all boats is certainly applicable to sectors as opposed to general market averages. So it is true. It's much more true for sectors. If you own a company that's not doing very well, but its sector is very, very strong, then there's a really good chance that your stock is going to go up with the sector, with its peer group. And this is because more than 80% of the trading in the stock market is done by fund managers who buy groups of stocks. These are called index fund traders. More than 80% of the stock traded is done by index fund managers. So therefore, they buy a bunch of tech stocks all at the same time by pushing one button without knowing much about the individual companies. A lot of times they don't even know what companies they're buying. So step one is to focus on sectors. The most popular investment websites like Yahoo Finance, Morningstar, MarketWatch hide the sector of the stock. Okay, so when you're done with this, go look around on Yahoo Finance, Morningstar. Look at how easy it is to, or how difficult it is to find what the sector is very, very quickly. And the reason is it's not the sexy part. It's not what's going to sell ad space. It's not what people want to look at. But you should be one of the few individual investors who looks at what you need to look at. So again, we just said that the most popular investment websites basically bury where the sector is. Okay, so if you enter a stock symbol, it doesn't immediately show up. It's not easy to see. You have to kind of dig. And I just told you that the sector is the most important part of investing in the stock market. So let's test your sector knowledge. Can you name one bank stock, one S&L stock, so savings and loan, one Wall Street stock, one insurance stock, one financial or one finance stock? Because these are all financials. They all fall into the major sector, financials. So can you name a bank or an S&L? What if bank stocks are doing very well, but savings and loan stocks are not? These subtle differences mean a lot because the index fund traders know that they're buying bank stocks across the board, but not really so much the S&Ls. Or they're buying Wall Street stocks like Goldman Sachs, but not insurance stocks. Another question, what sector is Netflix a part of? It's a pretty popular stock and it's a pretty popular service that people use. What sector is it in? What sector is Choice Hotels a member of? And little hint, there's no hotels sector. So with that in mind, what would you say the sector is for Choice Hotels? It's leisure. Name a chemical sector stock. Name a building sector stock. A lot of the stuff you don't know, and it's the most important thing to understand about the stock market. So you want to look at all 41 subsectors, not just the 11 major sectors, but those major sectors are only economic indicators as opposed to smart ways to group stocks in the same peer group. So if you want to be laser focused and have the highest probability of making money, focus on those more narrow sectors, 41 subsectors. By the way, they added a major sector, so they added the real estate sector. So the market used to be divided into 10 major sectors, but a couple years ago, they added an 11th major sector. The thing is, it's very easy for the media to just say technology sector because it can't really break it down into more narrow sectors. It just takes too much time and takes your focus away. The way I do it, very, very quickly and extremely simply, is I look at a sector bell curve. It lists all 41 sectors, and I also have 5 additional international groups listed in this bell curve. So the sectors that institutions are buying the heck out of are in green. And this tool actually tells you, it lets you see if the sector is overbought with institutional investors selling out of it. And it lets you see if a sector is oversold with institutional investors beginning to buy it again. This is one of about 20 tools found in something called sector profits. Now check out how the 11 major sectors can cover a lot of the subsectors. So like the consumer discretionary sector, for example, right in the middle in red, aka consumer cyclicals, there in red, has 8 subsectors. So it's hard to tell when CNBC tells you consumer cyclicals are selling off what that even means. Like CNBC says consumer cyclicals or consumer discretionary, they're behaving like they want to go down. You don't want to just blindly sell your stock that's a member of the restaurant sector just because restaurants are part of consumer cyclicals, because restaurants might be that one bright star within cyclicals. Maybe leisure stocks and retailing stocks are doing terribly, bringing the major sector down, but you have that one bright star doing well, and you don't, which would be the restaurant sector. So, okay, on to step 2. And you'll notice that step 2 builds directly on top of step 1. Step 2, buy the sectors institutions are buying in bulk. I can't stress the importance of this enough. It's the main driving force behind our sector buying strategy. There's lots and lots of places to look for signs that institutions are buying or selling a stock or a sector, but they're not as accurate or not as helpful as this. Some people look at trading volume, pretty basic, it is helpful. Some look at price behavior to see if a chart's making higher highs and higher lows. Both are pretty basic. But what I follow is a very easy program. It's the most reliable set of tools that I've ever seen in my 20 plus years of investing professionally. Every one of the 41 sectors have what's called a BPI, or a bullish percent index. And the sector's BPI is one tool that tells you if institutions are buying or selling the sector. It also tells you how much risk there is in the sector. And this is so important because when institutional investors start buying a sector, they tend to keep buying it and buying it and buying it for more than a year, sometimes several years. The sector's BPI tells you when they start buying before it becomes obvious to everybody else. Look at these 46 sectors on the bell curve. Remember, there's 41 plus 5 international ones. The ones in red were being sold by institutional investors when we snapped this picture. They may still have been going up in price. Everybody else would see the sector index going up in price, but institutions had begun selling out of it. And then ultimately the prices tend to drop. So we want to buy into sectors that have institutions buying alongside of us. Those are the ones in green. When we're buying stocks that are members of sectors that institutions are buying, we have the wind at our sails, so to speak. We're swimming with the current. Most of the trading in the stock market, like I said, happens automatically based on computer programs. They buy large groups of stocks all at the same time. So if institutional investors' software programs are set to buy stocks in the buildings sector or in the gaming sector, the sectors that you see all the way on the right, then the program will automatically buy a bunch of stocks in the group without considering the fundamentals of the stock itself. I want to be a buyer of stocks that are being bought automatically by these algorithmic software programs that us institutional investors are always using. Remember, I myself am an institutional investor, and I myself tend to trade tens of millions of dollars in equities or even hundreds of millions of dollars in equities. So when you have a whole bunch of institutions like me buying into a sector, individual investors like you can pretty much jump on board and let us push the prices up for the next year or two as we accumulate that sector. So that brings us to step number 3. Even acting just with steps 1 and 2, you're in great shape. But step 3 is the icing on the cake, and it really speaks to the velocity of the movement of the stock that you're in. So step 3 is buy sectors that outperform most other sectors. So we're going to sort of layer this strategy on top of the last one. And I'm going to show you why this methodology is superior to just about every other investment approach out there. And I'm going to show you just one study, but just know that there's hundreds of studies out there from hundreds of different firms that were done in many different years, different decades over the last century that invariably prove that investing in stocks and sectors that are relatively strong yields profit returns that are superior to the benchmark averages like the Dow Jones. Fewer than 10% of fund managers do better than those benchmark averages, and since relative strength investing has proven to beat the averages that 90% of professional fund managers can't beat, we think it's insane to invest any other way. So here's a few of the studies proving the superiority of relative strength. Or it's a few parts of the same study. We're going to look at one study in many different ways. So here you see 4 lines on your screen. Each line represents a group of stocks. So basically each of these lines represents a basket of stocks. You could say each line represents a hypothetical account value if 4 different investment accounts followed certain investing rules, like different sets of investing rules. So imagine that there are 4 investors, 4 people who followed a different set of rules, and we tracked their account value and their account growth over 25 years. In fact, the investor who's represented by the orange line multiplied their account by over 28 times. And you can see the bottom 2 who only multiply their accounts by 5 or 6 times, or 5 or 600%. So what you're looking at are 4 different hypothetical account values. Each of the 4 accounts followed a different set of investing rules, and I'm sure that you guessed that I'm about to explain how my investment rules get you the performance more like the orange line on the screen, but you'll change your investing life dramatically for the better if you understand what these rules are and how they're applied. And this is just a baseline to show you how to beat the averages, but what I'm going to layer on top of this shows you how to make 8 or 9 times as much profit as you'll see on this study. So the rules are actually pretty simple, extremely simple. When we look at the price trends, you have your short-term price trends and you have your long-term price trends. Most investors understand that within those bigger long-term price trends, you're going to find lots of little ups and downs or lots of little price trends within the big price trend. So let's go to another slide and come back to this in a minute. And remember, These lines each represent an entire portfolio of stocks. Really, they each represent the average performance of hundreds of stocks. But the next slide explains using one stock as an example. So let's take a look here. Is a great example here, Apple. And this is a great example. What we're looking at is a relative strength chart it was snapped in May of 2018. And this is the key to making the most money with the least amount of risk in the market. And I'm going to dive into that in a second. But whatever tricks and high-risk games that people out there are telling you should do to get the best returns, please don't listen to them. 19 out of 20 of these guys have no understanding of risk-adjusted returns or risk management, never managed money in their lives. All right, so the chart you're looking at is the key. This is where you need to pay the most attention. All right, so this chart compares Apple, the stock Apple, to the stock market, the S&P 500. So it compares Apple to the stock market. In the 2 years leading up to May of 2018, and this is called a relative strength chart, by the way. It's a relative strength chart comparing Apple to the stock market. And it shows the 2 years leading up to May of 2018. When the chart was advancing, Apple stock is outperforming the stock market. And when the chart declines, Apple's underperforming the stock market. Does everybody understand that? If you can type your answer, that'd be cool. If you could type into the chat box. Again, when the chart is advancing, Apple was outperforming the stock market. So that means Apple was either going up by more or down by less. Either way, it's outperforming. All right. So it's a relative strength chart of Apple versus the stock market. If anyone doesn't understand that, then please tell me now, because this is the key to everything. Just give you a minute or a few seconds, I guess. This concept's the foundation to everything. Type if you get it or not, please. All right, I'll explain a little bit more here. Just bear with me, folks who get it already. This is important. So, in other words, Apple and the stock market can both be in decline, but as long as Apple's going down by less, the chart on your screen is going to go up. Like if Apple declines only 5%, stock market declines 10%, this chart goes up. Just because Apple declines by less than the market, it'll go up. So if Apple and the market both go up, as long as Apple's going up by more, the chart goes up. Or on the other hand, if Apple's going up, but it's going up by a lesser amount than the stock market, then this will decline. Does everybody get it? Okay, so here's the point and what you need to know before we go back to the last slide. All right, question. In which direction is this chart moving? Answer in the chat box if you can. In which direction is this chart moving? The chart's going up. I mean, it depends on the time frame that you're looking at, but from the left side to the right side, it's going up. Actually, you can see it. It seems to be going up in the short term and in the long term. If you look on the right side of the chart, that little last jump up higher. So the short term is going up and in the long term. So this is a 2-year chart. If you can see that ever since the low, look at the lower left, in May, June of 2016 through 2017, the long-term trend has been up. Again, it's the long-term trend, the bigger trend. So the bigger trend or the long-term trend is that Apple's outperforming the stock market. And I'm purposely being repetitive here because understanding this concept can make you 10 times wealthier. Now, as you look at the chart, you can also see that it didn't go straight up, right? It zigzagged. So what does that tell you? If you could type the answer to the question, that'd be great. What does that tell you? What does it mean that there are short-term ups and downs within that long-term advance? And while I'm waiting for that answer, I'll point to the top left. You can see the symbol that I typed to get this chart, Apple versus the stock market, is AAPL $SPX. That's what pulls up the relative strength chart of Apple versus the S&P 500. All right, so I see most of you get it here. The answer is that the zigzags in the short term are there because even though Apple definitely outperformed the stock market over this 2-year period, over the long term, what happened in the short term is sometimes Apple would be outperforming and other times it'd be underperforming, right? That's why you see the short-term ups and downs within that long-term trend. All right, so what we see here is sometimes Apple is showing long-term relative strength and short-term relative strength all at the same time. But other times, when you see those pullbacks, it's showing long-term relative strength and short-term relative weakness. That's when you see the short-term declines in the chart within that long-term uptrend. So we can see the entire chart pretty much has long-term relative strength, but within that are several periods of short-term relative strength and short-term relative weakness. Okay, so remember these 4 lines, and each line represents a group of stocks, right? Or each line represents a hypothetical account value, and it assumes that each investment account followed a different set of investing rules. So there's 4 accounts, each following a different set of rules. And what you want to know, I'm sure, is what rules did the orange line account follow, right? So we just saw in that last relative strength chart of Apple versus the stock market, we saw that there's a long-term trend and a short-term trend in relative strength, right? Sometimes Apple versus the market showed stronger short-term relative strength and long-term relative strength, but others, it showed short-term relative weakness, right? When you have those small pullbacks. So basically, as is the case with any stock, we can assign Apple stock a relative strength classification. We saw how Apple, at the time that the chart was, the snapshot was taken, we could see that Apple was classified as having both long-term relative strength and short-term relative strength. Remember that last jump higher showed short-term relative strength. So Apple's a stock that had long-term relative strength and short-term relative strength, right? There were times in the past where Apple was classified as having long-term relative strength and short-term relative weakness, but at the time that we looked at it, it was classified as long-term strength and short-term strength. So keep that in mind. So the study that you're looking at breaks the market down into 4 groups of stocks. Those that are showing both long-term and short-term relative strength, like Apple was in the example, and then 3 other groups. So the way that Apple was just classified, those are the types of stocks that we want to focus on. But focus on just the best performing line here, the orange line. That one line from 1990 to 2015 represents one investment model that looks at all U.S. stocks and only owns the stocks that are showing superior relative strength in a long and short term. Every month, that model is rebalanced. So once a month, the model looks at every stock in the stock market and it says, okay, we will only own what's showing short-term and long-term relative strength and nothing else. Anything showing weakness in the short term or the long term is sold. It's no longer part of the orange portfolio. You guys get that? Type a yes if you get it, please. Type a no if you don't. So the orange line shows performance of a hypothetical model or a hypothetical stock account that owns only stocks showing short-term and long-term relative strength. Relative strength is just a simple math equation, really, and you can easily find out in seconds if any stock is showing strength relative to the stock market. It's very, very easy to do. I just showed you how to do it. And there are places where you can quickly filter down so that you're only selecting from stocks with this classification. So if it's outperforming, going up by more or down by less, then it's showing relative strength. The orange line shows a pretend account that owns all U.S. stocks that are showing short-term and long-term relative strength. Outperforms all other groups by far. And the other groups are either showing long-term relative strength and short-term relative weakness, or they're showing long-term relative weakness and short-term relative weakness. And then the gray one is showing long-term relative weakness and short-term relative strength. You want to filter out the other 3 groups when selecting the right stock or the right sector. And it'll give you a major edge over most other investors. So basically, you want to own stocks and sectors that institutions are buying the heck out of, like I said in rule number 2. And in this rule, I'm showing you how to make it even more likely that you'll own a big winner. And that's to buy stocks showing what? Long-term and short-term relative strength. All right, I'll show you the actual table that makes up the lines on this chart. So in the next slide you're about to see, I'm going to show you the exact same data, but instead of lines on a chart, it's numbers. And then I'm going to give you an awesome treat. All right, you can see the rows represent the performance for that year. In particular, the years are on the left column there, and you can see that best performing stock account, the orange one, is the first row after the dates, and then you see the other 3. But then we added another row. The other row, the 5th row, is the performance of the S&P 500 total return index. And we did this for comparison of returns. So average returns versus these different investment portfolios. So keep in mind, this isn't just the regular S&P 500. This actually performs even better than the S&P 500. The total return index that we're comparing to actually reinvests dividends, which makes a huge difference. It can jack up your average return by another 2.4% annually, which is huge when you compound that. The numbers are hard to see here, but first keep in mind that 90% of professional stock fund managers fail to beat the S&P, right? And then note, the 5th column performs even better than the S&P, so even fewer fund managers can beat this return that you see on the very orange column on the right there. Now compare the performance of the S&P total return to that of the first orange column on the left there that has long-term relative strength and short-term relative strength stocks. This study of model portfolios tells us that relative strength investing is superior to the stock market averages, certainly, and in fact superior to just about every other investment approach or methodology. I know I've been studying it for decades. Again, the study shows the high relative strength model making over 28 times the original investment over 25 years. When the stock market total return index only showed 9 times, even with dividends reinvested. So what does that mean? Relative strength investing as a style is a solid style. But what about the risk-adjusted rate of return? Does everybody know what risk-adjusted return means? Consider this. When you have 2 fund managers that show identical performance, how do you know which one's better? Like if 2 fund managers show 30% return, then how do you know which one's better? It's the one that took on less risk in order to get that 30% for you. So what if one risked 10% of your portfolio to get the 30% and the other risked 60% of your portfolio to make that 30%? The risk or volatility of any model portfolio like this can easily be quantified with different math equations. But here we'll start with the Sharpe ratio, which is a very, very common measure of risk. All right. Now, using the tale of 2 fund managers who both made 30%, the one who risked only 10% would have a higher Sharpe ratio. The one that risked 60% to get you that same return would have a lower Sharpe ratio. So you want to see higher Sharpe ratios. So watch the screen at the bottom, and you're going to see the Sharpe ratio of all 4 investment models, as well as the stock market Sharpe ratio. Sharpe ratio for the general market is 0.51, and for our relative strength model, it's 0.70. So the risk-adjusted return is far superior in the high relative strength model. Again, we didn't get these returns by taking on a great deal more risk. All right, so keep watching the bottom chart, or the bottom of the chart, because there's another measure of risk called standard deviation. It's a pretty basic concept. That's a volatility measure, and of course, volatility equals risk. Highlighted in green and above standard deviation, highlighted in green, you can see the average annual returns. And when we squint our eyes and we look at the returns compared to that volatility measure, well, our high relative strength model gained over 28 times the original investment when the S&P only gained 9 times the investment. So our model gained over 3 times as much in value than what the S&P gained, 3 times as much profit. But when we look below that at the green line, you see the standard deviation for us was 19.87% versus the stock market's 18% standard deviation. So we barely added any additional volatility and risk, and our portfolio made 3 times as much. We only scratched the surface with the model comparison. That part of this presentation only proves that relative strength is superior as an investment approach and as a methodology. But remember, we add layers of probability on top of what you just saw. All right, so let's recap what we've learned so far. Step 1, we always focus on sectors. Step 2, we buy the sectors that institutions are also buying in bulk. And step 3, we buy sectors that outperform most other sectors. So that's layers and layers of probability we add on top of what you just saw in that relative strength study. How much do you think your life will change after you master this 3-step process that I've just shown you? And I mean truly master it as I have. Think about what it would be like when you're able to pick trades more confidently and execute them more confidently and profit more confidently. In fact, I want you to think about what you would do if you were able to use my 3-step process to double your entire portfolio's value in the next few years. That is not impossible, even when you're using conservative, proper risk management strategies like the ones I employ. In fact, just as an example, one of my members, John, just recently wrote in, and he told me about how I helped him double his 401k account. Think about that. 401k account's a retirement account, generally a conservative account. They have rules in there in a lot of 401k accounts that don't allow you to get too speculative. Once you've done something like that, doubling a 401k by the power of compounding returns, your potential gains only get bigger and bigger, and those big potential returns feel absolutely great, I promise you. But how can you be sure you really make the most of what you learned here? Well, truth be told, sector focus is sort of the training wheels to something much bigger and much, much better. Thank you so much for being here with me today. I hope you learned a lot of valuable things today, and thanks everyone.